Hello and welcome to Funded Futures. My name is Emily Macfarlane. I'm your host, and today I am joined by Josh Sprague, who is the founder of Trove, which is an app that is democratizing investment for alternative assets. Welcome to the podcast.
Thanks, Emily. It's a pleasure to be here.
Look at me trying to get that mouthful of a description.
I know, there's a lot there.
I think I nailed it. I think we're okay, thankfully. But I'd love for you to give us a bit of an explainer as to what you're trying to achieve. I mean, I personally love this. I feel like the rich just get richer because they've got access to a lot of alternative assets that, everyday Australians don't have access to, and it's frankly unfair. So tell me what you're trying to achieve.
Yeah, and I think that's a really good starting point. A lot of people wouldn't be aware that within Australia we essentially have what I like to refer to as a two-speed wealth economy. If it feels tough to build wealth now, that's probably because it is. And a lot of us, I guess, retail mum and dad investors are actually locked out of being able to access a whole number of asset classes that do help, as you said, to make the wealthy wealthier.
Mm-hmm.
So really the reason and the purpose behind Trove is to democratise that. How do we give people access to different asset classes that can level the wealth playing field, and really start to give people a chance to build some meaningful wealth? And I think also you see the shift at the moment in some of the tried and true methodologies of building wealth. Most likely some of you or most of your listeners have had their parents tell them, you know what, you should just buy a property, get your foot on the property ladder and it will just double every 10 years.
I'm triggered.
So, but that was fine, I guess, over the last 30 or 40 years of prosperity where house prices just keep going up. But now the barriers to get into property have been higher than ever before, even though we do have the 5% deposit scheme, which means house prices are likely to go up again. But the barriers to entry are quite challenging, and it can't continue perhaps to go on forever where it just doubles every 10 years. So I think for Australians, there needs to be another way, another vehicle to help them build meaningful wealth. I mean, let's face it, there is a cost of living crisis.
Yeah.
But any leftover income, it's like, where do you find the time and the energy and the knowledge to go and invest that effectively to get yourself a return?
Yeah, 100%. I think that's often the barrier to entry is the knowledge element, knowing what to invest in, when, how. And there's a lot of digital investment platforms out there. How do you know which ones are legitimate and, what kind of asset classes that you're supposed to be investing in at any given time?
Yeah, and I guess I should say this is not financial advice, of course, as a disclaimer. But yeah, look, it's a great point. I think what you see in the Australian landscape at the moment, I call them self-directed investors. Essentially, you can access a platform which will give you a chance to invest money into the Australian Stock Exchange, even the US Stock Exchange, and other places as well. The trick is, though, that's great, but you need to know what to invest into. Let's look at the ASX, for example. I think there's more than 2,500 equities companies that you could choose from. So it's a little bit like a crapshoot. So you're trying to, pick the eyes out of a couple of stocks and hope, you hope that you might pick the next Afterpay at $6 and it goes to $120 and you get a massive return, but the chances of that happening are probably pretty unlikely.
Yeah.
And then the next part of that is a lot of intermediate novice investors will try and get diversification through exchange traded funds, so they're called ETFs. Which is also a great option, but it almost becomes a little bit like forced savings. You're not necessarily going to get the returns that you would hope for on an individual stock or elsewhere. So they're kind of shoehorned, I guess to sort of round out that point, Australian retail investors are shoehorned into two very specific asset classes, which are property, residential property, or equities. So there are two options.
Okay, it's pretty grim when you think about it like that. And also a lot of people don't really know what classifies as a retail investor versus a wholesale investor. Can you explain that a little bit?
Yeah, I will. And this is something I discovered working, as I mentioned before, working within the industry, within the retail investment industry, is that there's this whole subset of customers that are known as sophisticated investors, or 708s is the fancy term for it. Now, 708s, essentially, to qualify as a sophisticated investor, as we sort of touched on before, you need to essentially have $250,000 worth of income 2 consecutive years in a row, or you need to have more than $2.5 million worth of assets, which can include the residential home or your home. So so when I found this out, this is quite interesting. So by proxy, and what that means, by proxy, you get access to a whole raft of new asset classes that retail investors don't get access to. So the things that we're talking about are private credit, private debt markets, private equity, venture capital, and a whole raft of other asset classes. Commercial property tends to be one of those as well. There's a couple of reasons for that. They do have slightly higher risks, but obviously they have better risk-adjusted returns. So that's why wholesale investors like to put their money there. I like to say to a few people, I have said to a few people, it's very hard to win if you don't know what the rules of the game are, or what game you're playing. So, I like to say that if someone is wealthy, they're not like the rest of us. They're probably not going to be parking their money in a term deposit or in the bank at a 5.5% interest rate. They're more likely to be putting it into a private credit market and getting about 9 to 12% return on their money. So very, very different game once you cross that threshold. And I think it's really important as well to point out that although we're talking about this term as a sophisticated investor, these individuals, you'd think that, as the term suggests, they must have to do some sort of a test, right?
Right.
Yeah, like they must have to do a test that makes them sophisticated and advanced at what they do. But that's not the case. It's just the fact that you've crossed a threshold. You're already pretty wealthy. Congratulations. You tick the box to make more money, apparently. So
that's so wild.
Yeah.
It's an interesting way to really consider that the richer get more opportunities to invest in these alternative assets versus, I don't want to use the word poor, because it's not poor.
No.
It's everyday Australians who actually make a decent wage, but they don't qualify for these investment opportunities. And I think it's such a shame. And I think what you're trying to do with Trove is give people the opportunity to get access to these alternative assets. I know you're trying to raise capital at the moment, and a lot of VCs don't necessarily want you to succeed. Why do you think that is?
Yeah, look, I think it's twofold, because essentially we're attacking the already wealthy, which tends to be a lot of VC funds.
Correct.
Right. So they have the benefit when they're raising capital for those VC funds. They get to set the terms. There's a whole raft of reasons why we are challenging that space. Essentially, we could end up having our investors invest into VC funds and sort of controlling the terms or having a say in that space as well. So for them, we're a challenger to that very idea of, essentially what we see as well, these guys, they've made it and they're wealthy and they're trying to pull the ladder up behind them, so to speak, so that no one else can climb up and build wealth themselves. So, yeah, I think that we certainly challenge that space. I think there's also a disbelief from a lot of VCs that we talk to that the liquidity problem with alternate investments, because they're not necessarily highly liquid and highly tradable, so meaning you can't withdraw your money at any old time, that we're unable to solve that problem. But we think we've cracked it. So, yeah, it's been an interesting journey on raising capital, that's for sure.
Yeah, I can imagine. I think that it's that thing that, sure, knowledge is power, but sometimes just finding out about these things and finding out about the barriers to entry that the richer don't want you to get through is so frustrating. It's so infuriating. And I almost just want to block my ears and not hear about it, because it does make me so angry. Was that really the catalyst as to why you thought building Trove needed to happen?
Yeah, absolutely. I think to find out that there was literally, it's government legislated from 2001, there is literally legislation that helps the wealthy get wealthier.
Gross.
Yeah.
Gross.
So we've just got to do better. And I think as well, like, the middle class is struggling because they can't build wealth. All of the things that we were told that were true, let's say 20 years ago, get a good job, go to university, all of those things, and you should be able to lead a pretty good lifestyle. They're not true because we just don't have the wealth building vehicles that we used to have.
For sure.
And I think that needs to change.
Yeah, it's pretty wild. I mean, I did all those things. I earn a decent wage and all I can do is rent because I don't have this large chunk of cash that I can part with. You've actually got a really interesting acronym to describe those kinds of people. Can you talk about it?
Yep. So you may have heard of the acronym before, the HENRY, so high earning, not rich yet. We prefer to focus on the HENWE with a soft W, so high earning, not wealthy yet. And really what we see is these guys are the emerging middle class, and it's exactly like what you pointed out. They are outperforming their peers, usually earning pretty good money. They may or may not have a family. They may or may not own a property as well, but they are just keeping their head above water. And, they're not wealthy yet because they don't have the time to put into building wealth. Let's be honest, investing's great provided you don't have a day job, right? But these guys are also thinking to themselves, oh, maybe I'm just that one promotion away from, a bit of financial freedom and being able to sort of build wealth. Or the other point might be, oh, well, when the kids finish school, we'll be okay. So, and
that's when you're old and wrinkly.
That's a good point.
That's not when you want to enjoy your finances.
Not really. And also, like, during that period when you've got kids, you've got school fees and things to pay for potentially. And I like to say that Trove is a little bit like your superannuation, but you don't need to be 3/4 dead to access it. So there's nothing worse than looking at your super balance and going, oh, that's great, can't touch that for another 25 years. So that's what we're trying to really create is a wealth building vehicle that's truly diversified, giving people exposure to alternate asset classes in a safe way that's liquid.
So how does it work?
Essentially, customers are able to choose from a number of portfolios. We like to make them matched up to goals, so it's goal-based because let's face it, you're probably going to be more driven if it's matched against a goal that you're striving towards. Customers will choose a portfolio, and that portfolio has got a combination of different alternate assets in there combined with regular listed assets that our investment team chooses. It's fully automated, so the portfolios are rebalanced, so you don't have to worry about doing buy or sell. The other thing that was a big driver behind this, like I said, about time poor professionals, is that you don't necessarily want more choices. You just want to be more confident in the choices that you have. Like I mentioned before, 2,500 options on the ASX. That's like sensory overload, too much. What do I choose? So we take the hassle out of that, and our investment committee makes those choices on your behalf. It's automated, and at any time you can withdraw your funds as you need it, and need it as life happens. So that's sort of how it works. We're an app, so fully digital, because let's face it, most of us millennials and beyond probably don't want to go to a financial advisor either.
No, I don't.
Maybe your listeners, I don't know how your listeners will take this, but look, I think about the financial services industry and advisors. That industry has very much been set up for boomers. It's a one-to-one relationship. You'll go and meet with your financial advisor. And the first trouble here is as well, you're usually finding your financial advisor through a recommendation from someone. So you might be at a barbecue, or it's that, strange uncle that you've got that's like, you know what you do? I've got a great financial advisor. Go and talk to him. And, you're in this weird position where you go and you don't really know much about them. You'll sign a bunch of forms. It'll cost you probably somewhere between $3,500 and $5,000 for the year. And then you'll see them next year, and usually they won't have outperformed the market, and you'll have sort of incrementally gone up. So that, I think, that is maybe a relic of the past. And, Trove really hopes to sort of democratise, not the advice side, but the access to some of these things without the hassle for digital natives.
Yeah, there's so much that resonates with me, particularly that decision paralysis in where do you put your investments. I look at the ASX and I look at it like gambling, and I say, okay, this could go really well or this could go really badly. This is why I don't touch crypto, because it terrifies me. And a lot of people, I work in financial services, and a lot of people around me don't touch crypto as well, because it is such a volatile asset class. How do you feel about it?
Yeah, look, crypto is probably, I think that it's a leading indicator for what we're talking about. And what I mean is that if you don't feel like there's a lot of options for you to build wealth, you're going to start to take on unnecessary risk. And unnecessary risk is definitely crypto, because it's very volatile, as you pointed out. There's also a FOMO.
Oh gosh, yeah.
You know, I need to be in it, because if I'm not in it and it goes up and I wasn't there, people have that massive FOMO. But I think it goes back to the point that people are looking for ways to try and build wealth outside of the norm, because the normal channels are not there. So crypto becomes one of those channels.
Yeah, and we're not about to start an OnlyFans anytime soon, are we? No. So I think that the wealth options are fairly limited in that sense.
Yeah, that's right. And but also, like, it's eyes wide open, because not everyone, you know, the majority of people probably aren't making money on crypto. They probably aren't. There is a few that I've met one person in my time in fin services that was retired at 45 from crypto, but that is one person. They were worth millions, got into crypto early. But those stories are few and far between. You're trying to play, I guess, the crypto lottery in the hope that you get the next meme coin. But also you need to be prepared that you might go to zero and lose everything.
Yeah, which is a terrifying prospect, and not really one that entices me into it, if I'm honest with you.
Yep.
But something that I'm really passionate about is equity crowdfunding. And what you've said about VCs not wanting to invest in companies that threaten their ability to make money and remain, you know, the only people who can get access to those investment styles, it's hand in hand. So a lot of companies that go down the equity crowdfunding route, or also known as crowdsource funding in Australia, CSF, they have been rejected by VCs. The VCs will say, come to us when you're at this stage. And they say, okay, we're going to do equity crowdfunding. They say, oh, if you do equity crowdfunding, we won't take you later. And the reason being is because they don't want everyday Australians getting involved and being on that cap table, and they don't want founders setting the terms of their offer, because it means that they can't set the terms, and they can't set terms that are going to benefit them directly. And it makes me so angry. It makes me so angry. And that's why when I came across Trove, I was like, this is brilliant. And when you said that it's been a struggle for you to raise capital from VCs, I wasn't surprised at all. They're really in it for themselves.
Yeah, very much so. And I think there's also, it's not just the initial investment. You made a really good point. Remember, this is the game that is played by, let's go seed to Series A to Series B. And it's essentially what they're trying to do is at every round increase the value of what their previous round was of the investment that they've made. So, you know, and there are stories of VCs, you're not forcing, but you know, coercing founders into raising at a higher valuation because it makes sense when perhaps they didn't need to raise. But remember, it does benefit the VCs a lot of the time for you to sort of be raising at a new valuation because their stake becomes more valuable, and it gives them liquidity if they do want to get out at that point. So there's a lot of mechanics going on in the background that aren't all as they see. I've also heard, very similar to yourself, I've also heard and seen of VCs not wanting to take on crowdsource funding businesses, because it has a messy cap table and all this sort of stuff. There are ways around that I will say. So you can go through an SVP, a special investment vehicle that you can roll up all of those investors into one line item on your cap table. So there are ways around it that probably would negate this, I guess, problem with the VCs.
It's a tricky one. So this is actually something that is trying to get pushed through ASIC at the moment, and ASIC keep pushing back on it. I wonder why. ASIC is saying, don't think that we can roll them up into a nominee structure. Don't think we can put them into an SPV. Who works at ASIC? Am I making a lot of enemies here?
I probably am. I'm never getting funded by a VC now.
No, but I think that that's the thing. If people see the value in what you are creating, you'll get the right type of investors on board. The wrong type of investors are going to say no to you, and they're the ones who are not going to believe in your mission and your vision. And, you know, I actually I spoke to somebody who invests in a lot of companies and say it's a lot like dating, right? If you get rejected by a bunch of people, it's fine. You're not meant to be with them. That's okay.
That's it. What do they say? What's the say? You've got to kiss a lot of toads before you find your prince. And I think that's true, right? Like we've been through. I think I know who the person was that you talked to about this. I know him quite well. But he said to me, oh, yeah, they should all say no. 99% of them will probably say no, but it's a marathon, not a sprint. You just have to keep going. And it is a little bit like a war of attrition. You've got to pick yourself back up again.
Yeah.
Look, one of the things that we certainly experienced is, we went through due diligence. We've been through due diligence with a couple of funds. And what was really interesting is that we kind of got treated a little bit like we were guilty and we needed to prove ourselves innocent. So in other words, they're like, well, you could tell in the background that we'll put them through due diligence. And if they can convince us otherwise, we'll invest. But if they can't, we're never going to invest anyway. So we got to we go through due diligence for one particular fund. We get to the very end and they're like, yeah, we don't like this element. And we're like, guys, that was in our first pitch deck. So why did you put us through 3 weeks of due diligence and back and forth and, 36-month P&Ls if for you to say that, oh, we didn't like this element of the marketing or the go-to-market strategy that was in the original deck. So there's a bit of that happens.
The time wasters.
Yeah.
And the tire kickers.
Yeah.
That's such a tricky thing about raising capital is you're going to have to be prepared for people to waste your time.
Yeah.
How do you spot the time wasters in the beginning so it doesn't happen?
Look, I think we learnt some pretty important things along the way, and that was about qualifying questions at the very beginning. Ask them if they've got capital to deploy. Ask them about the types of investments that they make and verticals. And just also be wary. They will all tell you that, oh, we don't have any industry vertical. We're industry agnostic. Like, worry about that because they say that, but they probably have a very specific history of investing. So just the qualifying questions up front around timing will set your expectations, but also know that whether or not you should walk away if they're not really that serious. So, yeah.
That's interesting. And what do you think, since trying to raise capital, has been the hardest part for you?
Oh, that is an awesome question. I think that it's the spectrum of advice and feedback that you will get. That is really hard. So 1 week you might meet a VC and they'll give you advice. It needs to look like this. Oh, you know what you need? You need to do this. So you'll go and do this said thing that they've asked for. You add it to your pitch deck or whatever it might be. Or it might even be the amount that you're raising. Oh, don't raise too little. You need to raise way, way more. For example, you need to raise more because otherwise you'll get into market. You'll have no runway. And then you go to the next investor and they'll be like, you're trying to raise way too much. So we end up with, so it's like you get pulled from pillar to post and it's like you're trying to work out what's true and what's not. And that's the hard part. It's like, am I going crazy? Am I just being, there's no consistency in the feedback from different VCs. So you've got to sort of stick to your guns, but also use your network that's around you as well for advice. Because you can otherwise go off the rails and down the wrong path pretty quickly if you listen to everybody. You just end up with a bit of a mess. So stick to what you're trying to do and get some good advice from people you trust.
I think a wise man, Pitbull, Mr. 305, one time said, "Ask for money, get advice. Ask for advice, get money."
Yeah.
Twice.
Yeah.
Is this what we should be listening to?
It is 100% accurate, yes.
Yeah, I love Pitbull. Big fan over here. So every time I think about this for investors and for founders, there's this thing, right? If you're trying to get money, you're saying, I really need some money. How can I do it? They'll give you advice. And what you're saying is it's so frustrating. Do you think that there would be a benefit to being able to speak to a network of investors all at once in, maybe would it be a public forum or have that connectivity, like a chat room style kind of thing?
I think so. I think there's, but it's also, I think there's two sides to it. Like there is benefit in talking to investors all in one go, but the flip side is just making sure that they're aligned even about the advice that they're going to provide. I think as well, industry verticals, like for example, we're in fin services and fintech, asking someone that's come from a background in e-com, usually a lot of the VCs as well have either exited and they're now investing back into the community, but making sure that they're aligned at least to your vertical can be helpful as well. So industry knowledge is an important one. But yeah, there's definitely value in getting a whole bunch of investors to understand how it works. I mean, even down to the nuances of what they expect your growth rates, for example, to be once you go live. So, every 2 years, what their expectation is of what they want to see in the modelling and all that sort of stuff that no one ever tells you until you're kind of in it.
Look, I find financial forecasting to be pretty misleading.
I thought you were going to say a creative writing exercise.
Yeah, it's. I'm not going to swear on my own podcast, but yeah, I do think that it is ridiculous. And when VCs are like, "What are your projections?" How are you going to know?
It's like, mate, I can make these projections look however you want them to look.
100%.
Like all these numbers are made up.
It is wild to me.
But I get, look, the counterpoint to that would be that they are looking for your level of detail and thinking. The numbers tend to be irrelevant. It's more or less whether or not you understand the numbers. Do you understand how they work? Do you understand the unit economics of what you're trying to build? And that's a word that your listeners will have probably heard many times, is the old unit economics, and making sure that, what it costs to bring in a customer and, has a payback. Everything has a payback in your business, and understanding those numbers are really, really important. So I do agree though, but asking for things like a 36-month, we got asked for a 36-month P&L.
Sweet Lord.
And, we're pre-product.
That is wild.
It's like, okay, well, this is what it could look like, I guess.
And if you choose
and we
to
did
believe
it.
that.
We did it. And, it was a bit of a task, but they're the sort of things that you get asked for. And it is important to have. I think they would just, like I said, want to see the thinking, make sure that you know at least what you're doing, at least you've got an idea and you're not going in completely blind. And it's also looking about the detail. Do you understand the cost base of your business? Do you understand the growth rates and other things that are really important to your profitability and overall sort of growth?
So it's kind of a quiz, basically.
Yeah.
It's like this little exam. If you understand what we're asking of you and if you can complete it, even if it's kind of not true, you know what you're talking about. You're getting tested as a founder on your knowledge.
Yeah.
And if you can execute.
And knowledge and also, the thinking is the critical thinking and making sure that you haven't missed key elements or around either governance and things like that. So, or legal structures, all sorts of fun little things that might trip you up or might torpedo your business. They want to make sure that you've got a grasp of it.
Which is quite wise at the end of the day.
It is.
Because anybody can start a business, just like anybody can start a podcast, because obviously here we are. And I would never start a business personally. I've met too many founders to ever want to do that to myself. But that's exactly it. You can meet a smart founder and you can meet a dumb founder. I've offended many founders in my time by asking some pretty technical questions that they haven't been able to answer. And I've had to say, if I was an investor, how could I trust you to execute this business plan if you can't answer these simple questions? I think that's it, right? Like it's not about how accurate is this projection. It's about how smart are you and how much can an investor trust you to actually make this business work.
Yeah, I totally agree. I guess the counter to that though, if we're focusing, go on, yes. So I like this sort of this saying about, and I think I'll probably get this wrong, but I've stitched myself up here. So there's this saying that, the world favours those who take action, not the most intelligent in the room. And what I like about that is there is some truth to that just putting yourself out there and starting a business at times, sometimes you don't know the path and you don't know all the answers.
Yeah.
But all of a sudden, because you're out there, things evolve and they morph and they pivot, and before you know it, you've found yourself with a really great business, which had you listened to that little person on your shoulder saying, well, that won't work for this reason and that reason and this reason, you probably would never have started it. So it does go in both ways. I think sometimes people just sort of have a crack in it and it does turn out, and it's more about their resilience and their ability to listen to others and to keep evolving what they're doing that makes them successful, versus knowing how to do a 36-month P&L with fake numbers. You know what I mean? So there is, I think, nuances to it.
I mean, if we could bottle the confidence of a straight white male, I know I'd be investing into that, because every time I speak to a female founder, they don't put themselves out there. They have so much self-doubt, and it is so disappointing to see. I recently ran a pitch night and I had 20 people apply to pitch. One was a female. I regularly invite women to come onto the podcast to talk about their businesses and their journey, and they always say, oh, I'm not quite ready yet, or who would want to listen to me? I don't have that great a story. And I just want to shake them and say, come on, just give it a go. Just put yourself out there, because there are so few people who put themselves out there. And the ones who do, as you're saying, they're not necessarily smarter or better or doing a great job at what they're doing. They're not the only person who can do that, but they're the person who is taking that risk and who's being bold and brave and doing it. And that's all it takes sometimes, sadly.
Yeah, that's it. I think one of my old uni colleagues said to me is like, confidence is king, tenacity is key. And it is like, confidence is king. As long as you're confident and you believe in what you're doing, then being tenacious and resilient and being able to keep going, even though you're going to get knocked down. By the way, for your listeners, as a founder, just expect to get rejected a lot. And also, like, it's about that resilience. Like, you'll have good days and bad days. Raising capital is an absolute roller coaster, because you feel like, oh my God, I'm so close. We're going to do it. Oh, we didn't do it. And so, but you've got to be okay with that. That's part of the journey, and it's all part of the process. So, but to those female founders, get on the podcast, put yourselves out there. You never know where it's going to go. Yeah,
and what have you got to lose?
Exactly.
Like, I think that's it, right? Are you going to be the person who goes up to the hottest person at the bar and gets their number, or are you going to be the person who sits back and says, oh, damn, what would have happened if I went up and gave them my number?
Yeah, what do they say? You miss 100% of the shots you don't take.
Exactly. I feel like this whole podcast is just going to be cut down to sayings.
It's just going to be like these little tidbits of sayings from different places. Yeah, sorry.
It's like a mixture of you dishing out quotes and then me getting angry.
Yeah.
And that's it.
Yeah, totally.
Just my female rage just coming out. Because I do wish that there were more women who put themselves out there. But they often say that women who are more powerful and more successful are less liked than men who are, which is crazy. But the female instinct to be liked is so powerful that, I mean, I'm like that. If somebody comments on this podcast and says something negative, I don't forget it for a week, minimum.
So I might say something controversial here. I think that there are some female founders and female leaders that base their behaviours off white male leaders and leadership, that's how they are meant to behave when they get into a corporate setting. And so they adopt probably a lot of the worst behaviours and leadership qualities and traits that they have seen, because you're modelling it on what you've seen be successful. That's how you climb the corporate ladder, or that's how you, so that is my read. I've certainly seen that before, and that may explain your statement about female, the more successful they become, the less liked they are, but because they're modelling it on perhaps bad behaviours, they're not true to their values and true to themselves. So that's
a spicy take.
Yeah, that's sort of something to think about as well.
Yeah, that's really interesting. I think it's the perception of what power means.
Yes.
And how to be powerful can be misread.
Yeah, totally.
It's a really, really good take. So for founders who are thinking about starting a business and wanting to disrupt an industry, you're disrupting not just an industry, you're disrupting I want to say the structure of class and society that we have here in Australia. How would you say that people should pitch their idea and go for it? Because obviously it is so hard, like we've said.
Yeah, I think, look, finding incremental ways to test your ideas is really how it starts. I think that's the best place to start. And, you know, all you need to do is, my old colleague said to me, you need to just find that one customer that sort of believes in you, and then you need to work out how you get your second customer, and then third, and grow it organically like that. So I think that's the first part is, you know, work out how to test a lot of ideas quickly, work out how you can get to a place of getting a couple of customers and then growing from there. And also, you know, being okay if the idea is not right, then you can also kill it off if it's no good, but take the learnings from that and fold that into your next venture. And I think, you know, for most founders out there, you just got to keep grinding away. And it does sound very Gary V check to say that, Gary V, about, you know, just hustle and all that sort of stuff. It's not necessarily about the hustle. It is more about just this attrition of keep going, pick yourself back up. Okay, what gets you to the next phase? What gets you to the bit after that? What do you need to be true? What knowledge do you need to be able to build? And how do you leverage the people around in your circle that can lift you up as well? Because remember, you're not going to know all the answers all the time. So go and have coffees with people, get insights, get information as you can, and people will help you because they love talking about stuff.
Yeah, absolutely. That was very, very good advice, and I didn't ask for money to get it, so that was positive. But Josh, thanks so much for coming on the podcast, bringing out my rage, and, you know, I hope you've enraged a few of the listeners as well into a bit of action and, you know, to get themselves out there. It's been super positive, and I've loved chatting with you, so thanks for your time.
No worries. Thank you so much for having me, Emily. Cheers.